Hey everybody, it's Green Spud Trades, and in today's video I want to talk about the future of the SVXY fund, and the volatility party is over. So to refresh where my last video was about this topic, I talked a little bit about the XIV exchange traded note, which blew up at the beginning of February 2018 and was recalled. The XIV was a very popular product among retail investors because it was a bet, it was a short position on the Chicago Board of Trade VIX futures, which were in a perpetual state, well, most of the time, in a state of contango, which meant that rolling over the first month contract to the second contract would typically result in a loss if you're long the position, but for a short position that results in a gain. And as a result, when you're in a bull market and the VIX futures curve is in a state of contango, the XIV just keeps going up and up because from month to month those contracts are rolling over, and the exchange trade note increases in value. So what killed the XIV in February was that we had a move in the VIX futures curve that was approximately 100% up in a single day. And because the XIV was short, it was just like being short those VIX futures contracts, and it essentially got margin called. So if you're short a stock and the stock doubles, that means you owe the value of the stock, of what the stock was originally when you were shorting it, to close and cover your position. So let's think of it this way. There's a stock that's worth $100 a share. If it goes down to zero, the amount of money you made was $100 times the number of shares that you own. So the maximum amount of money you could make shorting is what the value is of the shares that you want short. So, if it's 10 shares times $100 a share, that's $1,000. But shorting is very dangerous because it could work the opposite way and work against you, and because stocks could go to infinity, you are at risk of potentially infinite losses. So you're short that $100 stock, it goes up to $200, well, you then owe an extra $100 a share to cover that position. So it means that you lost all of your money if it doubles. But if it goes more than that, then you will actually owe your stockbroker more money. So if it goes from $100 to $300, you owe $200 a share, and you only got $100 initially from the of a cash inflow from when you went short. So that means that you could potentially owe your broker more money than what your account's worth. And that's exactly what happened to the XIV fund, is that it was short a VIX futures position. The VIX futures, they more than doubled in a single day, and it just absolutely killed the fund because they owed more than what they had in assets. So it actually didn't go. There was actually a little bit of value left in the fund, but it was enough that Credit Suisse decided to recall the XIV. But there was another fund that does the exact same thing called the SVXY, issued by a different company called ProShares, and they didn't call their fund. What they did was they just allowed the value to become very small. It was over $100 a share just a couple of days before the event, and then it went all the way down to about $12 a share when it started opening the next day. So a lot of people, they lost about 90% of the money that they had in the SVXY. But going forward, the SVXY could continue to be worthy of the strategy of trying to make money off of the VIX futures contango and low volatility. So a lot of the people who were trading XIV decide, well, okay, I'll just trade the SVXY instead. So if you look at the chart for the SVXY, I mean, you could see during a bull market, it could go spectacular leaps and bounds here. So back at the beginning of 2016, I mean, it was down to about $17 a share. And then during the Trump bull market, it eventually went up to the $130 a share area. So we're talking like a sevenfold gain here. But now I have some bad news. And that bad news is that ProShares has announced that they're going to reduce the leverage of the SVXY fund to 50% from 100%. So this means that the returns that it will generate are going to be one half the inverse of whatever move it is that the VIX futures actually makes. So let's say that there's a move in the VIX futures of 5% up. That means that the SVXY fund will go down, instead of 5% now, only 2.5%. And I know why they're doing this. The reason is that they saw what happened in the XIV fund. SVXY got seriously hurt, and they want to give themselves some buffer for that sort of margin call situation again. And they know it happened once, so it could probably happen again. They're going to protect themselves and try to keep this fund going. So they've dramatically reduced the exposure. And what 50% means is that it would have the VIX futures would have to move, instead of 100% to break the fund now, they'd have to move 200%, because every percent move is now one half of what it used to be. And this is bad because it also impacts the contango. You'll be getting one half of the contango effect from the month-to-month rollover than you did before. So if contango is 9% from month 1 to month 2, a month goes by, you didn't make 9% on that money. You made only 4.5%. So just to show you kind of how this mathematically works, I made this little chart here. It shows what the leverage is on the SVXY fund and what sort of move you'd have in the VIX futures curve and what it would take to break that fund. So at 100% leverage, which is what it used to be, if you get a 50% up move in the VIX futures curve, and let's say you were starting at a value of $100 per share in the SVXY, the value would go down to 50. If you get a 75% move, then you would have a 25 value SVXY. And then beyond 99% or so, you pretty much break the fund and make it worthless. If there's a daily move of anything above 100%, then SVXY goes in the red. It pretty much just goes bye-bye. And the nice thing about investing in these inverse volatility funds is that you, as an investor who bought the shares on an exchange, aren't going to have to owe money. ProShares would have to owe the money to the Chicago Board of Trade because they're holding the actual securities, and they're probably not going to be able to come after you for that because you're just holding the security in your account. So from that respect, your losses are covered, but unless the company issuing the shares hedges, then they could end up in the red. And in the case of like Credit Suisse, they were fully hedged, so they didn't lose any money in their portfolio, which is a good thing. But basically the losses, you can't lose more than 100% if you're long a short volatility thing. But anyway, so if you go down to 50% leverage, which is exactly what the SVXY fund did, you have a starting value of 100. It moves 50%. That brings you down instead of to 50 to 75. If there's a 99% move, it only brings the fund down to one half of what it was. And to show you what happened to the VIX futures on that day, if you go back to February, what happened was you had the VIX futures being at about 15, and it went up to over 30. So that's over a double in one day, and that's the sort of action that broke the fund over a 100% move. For the VIX futures to be valued at about 15 now, for them to break the SVXY fund, it would have to make a move to 45. But now this also hurts the. It's a double-edged sword, because although the SVXY fund is protected, that's good for the company managing that fund, but it's not good for you as an investor, because your ultimate returns are capped. You lose the compounding effect that made it such a good security to own in the first place. So I made another chart here showing if you had let's say you had a 9% monthly contango, just what sort of gains you'd make on the contango alone over that 1 month, over 30 days of trading. Well, actually, a trading month is more like about 20 days, but you get the point of where I'm going at. You have a 9% contango, and you start off with $100,000. By the end of that 30-day period, assuming that the value of the VIX futures don't change, you just roll over the contracts, you will end up with about a 9% gain. But now at 50% leverage, you only end up with a 4.5% gain, and you're even losing a little bit because you're not compounding that as much. Now you could kind of make up for the nominal amount by playing in double the size of what you used to play with the SVXY. So if you typically like to invest like a $100,000 position, and then you're moving into doing $200,000 positions, you could probably get the same type of end returns in the SVXY nominally, actually a little bit less than that because it's not compounding, but pretty close. But then again, that means you have less buying power available now because you went in so heavily on SVXY. That's money that you can't invest elsewhere. It's your return on capital is going to be much lower. And not only that, but just to put all that money in a particular security limits your diversification. And let's say some other type of unforeseen event causes the SVXY to blow up overnight, something that we didn't think about. Then instead of losing $100,000, now you've lost $200,000 because that's how much you were trying to play with to get the same type of returns that you used to with the SVXY. This move to reduce leverage also is bad for the fund because nominally you lose more money. And here I made another chart. So something that is important to note is when I'm talking about the returns here, I'm talking about intraday price swings, because that's what the XIV and the SVXY are meant to mimic. The intraday movements the VIX futures. And then at the end of the day, they rebalance and then it kind of resets. But the what could happen is you could have, like, let's say, like a doubling of the VIX futures, and as long as it doesn't happen in a single day, the SVXY and the XIV won't completely blow up. So what I did in this chart here was I took a 5-day period, and let's say that they had like a negative 20% move each day for 5 consecutive days. So if you started out with a value of 100 in SVXY, and after 5 days of going down, well, actually 4 days in this case on my chart, you would have a value of 40.96, which means a loss of almost 60 points. At 50% leverage, your loss is going to be mitigated. You're only going to be losing 34 instead of 59. So, you won't, it won't blow up as easily. The downside is going to be protected a little bit, but like I said in the other chart, your returns are going to be severely capped, and it's not going to be as exciting to trade. It also means that it will probably take a longer time to recover from a severe down move like this. But then what I did here on this far right column with the 200 is, like I suggested, if about mimicking the same types of returns that you trying to mimic the same type of returns that you got before by playing with double the size. If you had consecutive days of it going down 20%, your nominal loss is going to be much bigger than when it was at a 100% leverage. And that's because you have more capital invested and you're just losing more. So, going double size, it will allow you to possibly mimic the returns that SVXY was getting before, but it also gives you a much higher downside. So how much? Let's see. We're talking like about 15% more down, or 16% more downside in this particular case. So in conclusion, I think, reflecting on my previous post about the SVXY and XIV, how it was probably some person with a lot of money who thought, well, I'll just blow up this fund and walk away with a few $1 billion, and they tried to push the futures over the edge. And after hours, very likely, I mean, the way Wall Street works, I'm pretty certain that's what happened. That it was a conspiracy to blow up the fund, but they know how to do it. They could do it again, and I think the ProShares people who issue the XIV, the SVXY fund, are conscious of that. They know it. They probably know that it could have been through market manipulation, and they don't want to be in that position again. So for their preservation, it's a wise move to reduce the leverage and do something to protect the fund so that it could keep going and they could continue to make fees of it. But it's not going to be as exciting as it used to be. You're not going to get that whole eightfold type of move during a few months of a bull market the way you used to. Another side effect that might happen also is, now that the XIV fund and the SVXY fund, which had billions of dollars invested in them, now that they're essentially broken, they're going to be less appealing to investors, which means that there's going to be less derived shorts on the VIX futures curve. In other words, the volatility index may not dip the way that it used to. You may not have the same contango, whereas it was typical to get like 9% contango per month. Now it's probably going to be less than that in a bull market. And when you consider arbitrageurs out there, it could have been that the reason we've had such historically low volatility before was because of the popularity of this trade that was reflexive in nature. And maybe with the VIX futures, there was sort of a tail wagging the dog situation where there were arbitrage algo type of funds out there that were actually affecting the options market prices in response to what the VIX futures were trading at, and then because the VIX futures were being pushed down, it could have also been pushing down the options prices and consequently the VIX. So it was kind of a reinforcing thing. I don't know. It's just a theory, but that could have been. We'll see what the lasting impact of the XIV blowup was over the next few months. We'll see if volatility returns to what was the normal levels before. But if not, then this volatility party is over. So that's what I wanted to talk about today. And this is Green Spud Trades. See you next time.